the topic here is the future of precious metals with a gold to silver ratio of 80 to 1. Is it overvalued? Or is silver undervalued? And so we have the intellectual academic answer here, and now we will have some industry answers as well. So if I could ask Benoit Salle from AuAg Gold and Silver to enter the stage, and you can sit next to Peter, and after that we have Strand, a portfolio manager and founder of AuAg Fonder. Give them a warm hand. And obviously we have John McCluskey, President, Director, CEO of Alamos Gold. And last but not least, Keith Neumeyer, President, CEO of First Majestic. Thank you. I will then start here by asking, and as you can see, I'm sitting down, so there won't be, we'll be in focus here. But so the gold-silver ratio historically has been between 40.2 1 and 80 to 1, and now we're 80-ish, and we've been up to 100. So my first question would be, how important is this ratio for you when you make your investments? And let's start here with the industry. When you look at your company and making your investments, how much do you focus on this ratio?
Zero.
And John?
The ratio, you know, mining ratio is 1 to 7. So for every 1 ounce of gold that's mined worldwide, the mining sector only produces 7 ounces. Yeah. So that's where the ratio should be, 7 to 1.
No. And for John?
Yeah, it's not really anything we factor in.
And now let's see what the fund manager will say. How much do you look at this, Eric?
Well, it's not that we look at it, but it is a sign. I mean, that there is more potential in silver and silver miners. So in that regard, it has some value to see. I mean, it's at 80 to 1. We want to see it at least to 71, 50, 30, 20, 10. So silver is cheap.
And Benoit?
We don't look at that at all, but I think the ratio is off because of central bank buying gold, and they've pushed the ratio up, and silver's got a long way to come. So when we look at what we're looking for, we're clearly looking for more silver deposits. But again, if your geology gives you gold, well, you take the gold
of course
as it is.
And Peter, how important is this when you make your research and your decisions?
It's a little bit of a mix. I do look at the ratio, and if I see that the ratio is high, like it is right now, I ask myself, I look at both metals, and then I say, okay, if I start with gold, I ask myself, where do I see gold and where do I see it going? And if I see gold going higher and the ratio is high, then I certainly expect silver to move up and catch up, and for the ratio therefore to fall. So on that basis, I find it very indicative of much higher silver.
And a follow-up question here would then be not so much to the industrialists, but starting with you, Peter, and then over to you, Eric, here. When you see this ratio, if you're a retail investor, would you buy then the underlying mineral, or would you like to buy the stock, if we start with you, Peter?
Again, you have to look at where you are in the market. Has there been a run-up potentially in the stocks? If that's not the case, then I would say buy both. It would make sense to buy both. Relatively, they will both be undervalued.
And for you, Eric?
Well, what we do see now is that silver is stronger than gold, and that's a good sign for the market. But of course, the returns are in the miners, the real returns. So that's the most interesting space.
And will because I mean basically we had a quick introduction to the demand of silver, and you can really see that it's an industrial demand, but it's also, let's say, a security demand or a national demand. Will the gap close? And because everybody knows that gold is safety, so to speak, but do you think that the gap will close, so there will be a larger part of silver investments that will go to, let's say, bank deposits or central bank deposits? So what would you say on the industrial side there, Keith?
Well, during the 2011 bull market, when gold hit 1,800 and silver hit just shy of $50, the ratio was around 31, I remember. So we could easily see that again. Whether we ever get down to what I think the ratio should be of 7-to-1, because that's the actual physical supply of the metal compared to gold. And as far as I'm concerned, that's where the ratio should be. But that's a long ways away from where it is today.
Oh yeah, very. And John?
There's very different fundamentals driving each of those metals, and gold is becoming an ever bigger part of central bank holdings. I mean, gold has always had in terms of a market for its annual production, about half of all the gold that was produced in any given year was taken up in gold manufacturing for gold jewelry, and that's been the case for I've been on the World Gold Council since 2008, and that ratio has been in place since then. But it has been overtaken in recent years by very strong central bank buying, and clearly the change of perception that has occurred over the last few years, which I think the central bank, the World Gold Council has been a big part of in terms of its outreach to central banks and seminars it's been putting on for many, many years, attended by central bankers from around the world. It's gained renewed importance as a fundamental holding of central banks right around the world. But as I was saying earlier in my talk, it's interesting the central banks that have been the buyers. It has been China, it has been Russia, it has been the BRICS as they were known, and virtually all the countries that trade with them. They're clearly in the process of setting up a parallel trade to the US dollar. And it's going to be gold-backed. And that fundamental, I think, is part of the reason why you've seen that ratio widen between gold and silver. And whether gold is capable of just by its ongoing importance as a monetary asset, if it's capable of driving silver higher, that I don't know. There's people on the panel who are much more knowledgeable about that than I.
Yeah, so let's just jump to the next, to Eric here. So, do you think that gold will be able to drive silver higher, or will silver in one way be, let's say, the cheap man's gold?
I think they will go both together. Gold will be the strong foundation, but with silver, you can get a physical shortage. And a physical shortage on a commodity, the price goes straight up. So it is very interesting with silver, but still it's very volatile, small market. So you have to strong nerves if you go for the commodity, but if you go for the companies, equity, even more volatility. So it's a very exciting times.
And if we then jump into AuAg gold and silver here, obviously, if you have gold and silver in your name, you're pretty happy, as it were, in this case. And surely, as you said, as a geologist, you will mine where you are and what you find in that respect. But do you see any changes in the industry, or that gold let's say silver in some way will replace gold, or will it be more of the same?
I think we are in uncharted territory. It's never been seen. Historically, we go back, we take a look, we try to find a pattern, but as we said, the central bank buying is good for everybody. It's good for China, it's good for India, it's good for Turkey, but it's also good for the United States, because they have very large reserves, we believe. And the higher the gold price, the higher will be the silver price, because the financial demand, which is not that big for silver, will continue to grow as the gold price goes up. So when people tell you we can see gold at 10,000 or 15,000, which I believe will happen, because that's going to help the United States balance their balance sheet, well, silver will move. And silver has more macroeconomic demand with what Peter talked about, solar energy, armament, chips, and all the industrial use. But it will also follow gold. And gold is the new denominator for countries' balance sheet. And Tether is a very good example. Tether are calling all of us to get streams, to put money into our companies, because they want to back up their coin with metal. So it's uncharted territory. It's only going up. I mean, it'll be volatile because it's a volatile market. But long term or even medium term, it's going up because of the industrial demand for silver and because of the institutional demand for gold. And you know, when you read that the United States, if they have $15,000 gold, then their debt is sort of in equilibrium with their asset. It's easy to get to 15,000 for them. It's very easy. But for all of us, it'd be a fantastic situation to be in. So, you know, high gold price, high silver price, low oil price. We're very happy.
And Peter, you'd like to add something there?
Yeah, I just want to add to what Benoit said, which is that, I mean, the way I see it, you've got, on the gold side, you've got central bank demand that's, I think, really driving it in a big way. For silver, you have industrial demand, that's the sort of the big driver. But as gold goes through 4,000, 5,000, and well beyond, which I agree, also much higher, 10, 15 potentially, as we go through these milestones, investors are becoming more and more aware. They're looking at gold. Many are finding it expensive, and they're looking for an alternative. And silver is that natural monetary alternative to gold. And at $50 or 75 or even potentially 100 or more, it's still going to look a lot cheaper than gold on a per ounce basis. So I think that will drive investment demand for silver. So we have to be careful about talking maybe too much about industrial demand. I think investment demand will definitely flow back. We're starting to see it with the, some of the physically or supposedly physically backed ETFs. And I wouldn't discount investment demand for physical silver.
But I mean, basically, it seems like the panel here seem to be fairly on the same page when it comes to one of the major drivers for gold will be central banks buying, and that is more or less a security of the nation's security or the currency security, whereas in silver it will be industrial demand, as it were. I'd like to pick up on one thing here with you, Keith, and you were saying 7-1, not...
That's the mining ratio.
Yes, that's the mining ratio.
Right.
Could you explain that for someone who is not so into the mining ratio as myself?
Well, that's simple. It's the amount of metal that comes out of the ground by all the mining business, around the planet.
Versus what you have in gold.
Right. So for every 1 ounce of gold that gets mined, 7 ounces of silver gets mined. But just going back to some of the other comments, silver will never become a currency.
Okay.
Gold is becoming a currency. And we're seeing that in front of our eyes, and that's why we're seeing a re-rating of gold prices right now, which John alluded to. And of course, it's hard for silver to go up if gold's not going up, because gold is kind of the granddaddy of the precious metals. But I do also think, with silver being 60% consumed by industry, 20% by investment, and 20% by jewelry, there's not a lot of room there for further demand. Because we're already in 5 years of deficits. So industrial demand will continually grow, in my view, squeezing the investors and out of the sector, because there just won't simply be enough metal around. You're seeing the mints, the Canadian mint, and I think the Australian mint has recently announced that they don't have any physical to sell. We have our own mint. We opened up our own mint in early 2024. We're the only mining company on the planet that has their own minting facility.
Yeah.
We've been selling silver to the retail public since 2008, and I got frustrated with the mints that we were relying on to produce our products. We had silver sitting on their floor that they just refused to turn around, and we had sold out signs on our website for frequently. And I got frustrated, and I decided to pull the plug on building our own mint. So we did that. It got up and running in March of 2024. September, this last September, was a record month for the Mint. So we're seeing retail buyers coming into the sector. It's slow. Retail investors tend to follow the market. It's like, it's like a stock. If stocks are going up, people are going to chase it. Same thing is going on with silver right now. We're seeing an unusually high demand from the retail base, which is quite interesting to see. But the supplies, are really tough to come by, and you're seeing now the premiums. You go look at some of our competitors; their premiums now are $5 to $7 an ounce over spot, because they're having to go in and buy the metal at current spot prices and then produce it, and obviously they want to make a profit, so the premiums are expanding. In the case of First Majestic, we have a mint called First Mint, and we're the producer. This is metal coming from our mines in Mexico, being shipped in the United States for refining, and then getting shipped to our mint in Las Vegas, where it gets produced in retail products. We don't have to charge those high premiums, because our cost is actually our all-in sustaining costs right from the mine. So we have that embedded profit of about $3 to $4 above spot just by going through the mint, and we're undercutting all other mints right now just because we're a miner that's producing the metal ourselves.
And I was picking up on one thing here, which I'd like everyone here to have some thought of, and that is that, so we know that the supply is scarce as it is now, and the demand is, we will assume that it will continue to grow. But if I look at you then, Eric, and say that, okay, so we know the base facts here, and disregards the ratio that could be between 80 and 40 to 1 or whatever. How would you handle this in your investment decision when it comes to, let's say, the shortage of supply? When you look at the market, are you looking at ETFs or the physical parts, or just the different companies?
Well, we do invest in AuAg, $15 million or $30 million in First Majestic. So we do invest in the companies. And what is interesting here with silver is that two things. There are very few primary silver miners.
Okay.
We have two here on stage, and I mean, they are the only ones that will really react when the silver price fly. They can try to produce more, but otherwise it's a byproduct. And these other companies, they will not mine more just to get more silver. So that's really interesting to focus on the primary silver miners. And then actually also that the price is very inelastic. I mean, you need the 30, 60 gram or ounces in silver in a car, but you cannot produce the car without it. But even if the price goes up 100%, 200%, it doesn't change the price of the car. So it means the industrial, they need to buy it, and they will pay whatever price. So this situation is very special for silver.
And I'm picking up on one thing that you're saying there, that is that it's a scarcity if you want to invest in, let's say, a pure or a purer than other silver investment on the stock market. Is that the right way to interpret what you're saying there?
Well, you try to find the primary silver miners, and we have two here.
Yeah.
And there are some more, but there are not so many of them.
Yeah. And John, if I address you, and you see the supply side is down, as being a, let's call it a deal maker in the circumstances here, what kind of metrics will you use for not overpay? Because it seems like it's a scarcity. There's a lot of people looking at the same assets, or is it not?
Well, as we're a gold producer.
Yeah.
And
in gold then. Yeah.
Yeah, we're effectively, I would ask myself, would I sell a gold mine, say, to buy 7 silver mines? I mean, that would be a normal question if you thought the prices of the commodities were so out of whack, and you could do so much better in terms of profitably mining the metal. And it doesn't work that way at all. in terms of, they're two separate businesses, really. I mean, we produce, in our Mexican operations, for example, I think at Mulatos, for every ounce of gold we produce, we probably produce between 3 and 4 ounces of silver as a byproduct, which we don't even report. We just net it against our costs.
Okay.
And effectively, it's an offset. But it's such a, they're both metals, and they're often talked about in the same breath. I'm sitting on this panel, but they're two fundamentally different businesses, and the economics behind them are very different. It's, in some ways, I think that the silver business is a trickier business, and the company, there isn't a lot of companies that have done really well at it, and you have a couple of the ones that have succeeded on your panel today. But by and large, it has been it's been a very difficult business as a primary business, as was pointed out. The majority of silver production, I would say, comes as a byproduct from production of from lead zinc mines. It's generally lead zinc mines. They will be getting their primary revenue from the base metal, but they get a credit on the silver production that they produce as a byproduct. That's a huge component of silver production in the world. And so primary silver producers are quite unique companies. And that means the assets that they produce from are very, very unique. So if you do get a run in the silver price, and you can see from those charts that every now and then you see a really significant run in the silver price, I think these companies do extremely well on that basis.
Benoit, any
No, I comment as a gold and silver.
No, John is right. I mean, it's gold is the value is much higher. The price has been higher. The problem with silver is the price has been low for a long time. So when you have $4, $6, $10, $12 silver, it is a very difficult business to make money. Silver deposits are a lot trickier than gold deposits, and historically we've been mining silver deposit in very, we're following veins and we're trying to mine high grade, whereas in gold you would mine bulk mining, wider, lower grade, bigger tonnage. And when I started years ago, you would never talk of a 1 gram per ton gold deposit. This was like you would give it away. I gave away a mine in Guinea that was 1 gram per ton. Today it's worth $2 billion and they're mining it. And we gave it for $1 in 2007 or 2008. Silver did not see this. Now it's starting. Now with the new silver price, we can change the method of mining from selective to a little bit more bulk, bring the grade down a little bit, increase the tonnage, and make money, which was impossible a couple of years ago. Now, Keith's been at it longer than me. In silver, I used to mine gold for many years, but now we're changing the method a little bit. We're going wider, lower grade, more tonnage, and it's very, very profitable. So with the higher silver price, we're changing the method a little bit, and it's working. But the silver deposits are really, they're trickier. They're much more difficult to mine.
And more difficult to recover. So silver is a tricky metal to get out of the rock. It takes a lot of chemicals and a lot of energy. Gold falls out of the rocks. That's why you see gold miners, your recoveries are, John, what are they, 95 or over 95%?
97.
Yeah, 97% recovery in gold, and that's common for a gold mine. Silver mine, 65, 75, 85 if you're lucky. Getting up into the 90s, you've got to have some pretty good ore and that's more unique. There's a lot of silver mines that struggle at 65, 70% recovery, and that's not that unusual. At today's metal prices, it's fine, but at $15 silver, $20 silver, a lot of those mining companies were losing money just because it's very difficult to get that silver out of the rock. It's totally different than gold. And then also silver, you said earlier about poor man's gold. Silver is not the poor man's gold. Silver is not gold. John was very clear that these are two completely different industries. And silver is very much a commodity. even though it is precious, but it's very much driven by commercial consumption. And that's very much different than gold.
Well, thank you for putting me straight there. We will take some questions from the audience as well. So if you just raise your hand, then you will get the mic. But before that, I'd just like to ask the panel here. We can start with Peter here. 5 years from now, do you think that we will have the same ratio, 40-80, or will we have a new norm? And what do you think?
I think
it's an easy question to ask.
To ask, yes, difficult to answer. I think overall the ratio will fall. I don't think it will fall to closer to historic lows. I think it will stay more elevated historically. And if I had to guess, I would say if it falls and stays elevated, maybe 60 average over the next decade or so. But I think with both metals much higher in price. Well, I did want to point out a couple of things on the discussion that we had just before this was that I don't know if the miners here will agree with me, but I've heard the argument that if because 75% of mined silver comes as byproduct, that with an elevated silver price, producers of silver as a byproduct are, one, not that motivated to try to produce more silver. And it's also not that easy to just ramp up mine production. So they'll happily accept a higher silver price, but not turn around and even try to produce more. They'll just be happy to get more money for their silver. The other thing is that those who perhaps are primary silver miners will start to look for areas of their deposit where perhaps the grade's not quite as high because they can now, at a much higher silver price, make similar profits to what they were making before and perhaps be producing less silver because they're now mining lower grades. And I'm not suggesting that's what would be done with these miners, but I could imagine the motivation to do that. So it's important if you're doing your research to look for, and if you want to invest in silver and primary silver miners, to look for companies that, I hate to say this, but there are some companies out there that will report their silver in silver equivalents, and yet if you look at what they actually produce, a lot of it is gold, copper, lead, or zinc. So I find it disingenuous for them to call themselves silver miners or silver producers when really they're producing other things, but they're reporting it as silver. So that's one thing that I do focus on, is companies whose production or their deposits are 40% or more, which still sounds perhaps kind of low, but if you don't have that kind of target as a filter for silver content or silver production, then you don't get enough interesting silver companies.
And Benoit, any comments there? And what do you think going 5 years out?
Yeah, well, I think I shown my color. I think 5 years out, we're going to see $15,000 gold and we're going to see $300 silver. But I think people forget one thing, is silver is driven by solar panels a lot these days. China announced that they will multiply by 6 their coverage of solar energy. In Morocco, 30% of the grid is solar and wind, and they're taking that to 50%. They're investing billions of dollars, and they're going to be sending energy now to Spain and to Europe coming from solar and wind. And I think this is a major, major force behind silver. So we will see. It will move because of financial demands, but the industrial demand on solar panel. And just to close on that, we build in our mines in Africa historically a solar plant because we want it to be green. And you can produce today 1 kilowatt of energy at 6 cents per kilowatt hour from solar. You can't do that anymore with water or with oil, certainly not in the new construction structures that we have. The only one that's more competitive competitive as nuclear, but then you need to build 3,000 megawatts, or like it's so big. So we see it in Morocco, we see it in China. The demand for solar is increasing, and it will continue to increase because it's green, because it's got everything. Now in the States, they're trying to say we're going to slow it down, but I don't think they'll be successful because it is the new energy, and that will push the silver price up. So I don't know about the ratio, but we're going much, much higher. That's for sure.
Yeah. And before coming to you, Eric, I was just going to ask John here, if we then look at gold, and we often refer to the central banks, they are buying gold. It wasn't too long ago that the central banks, for reasons unknown to me, were selling gold. Do you think that, when do you think that the central banks will, let's say, be happy with their gold reserve, or will it just continue?
Oh, I suppose it would be when there was peace in the world.
Okay.
When you've got, a saint in the White House who looks upon the world in a benevolent way and encourages globalization again. When everything's perfect and wonderful, which is not about to happen.
So not in 5 years.
I think things have fundamentally changed, and I don't think this breakdown which has happened with the election of the Trump administration, I don't think the Americans are going back from that anytime soon. And in other words, we're going to see Trump come and go, and we're going to see a Trump 2 come in after that. And I think U.S. policy has taken a fundamental change, and the world knows it. And there's a complete realignment going on, and I think that the world is by and large for years been losing faith in the U.S. currency. It's not like central banks have just started buying gold in the last 6 months or so. No, they've been accumulating gold for years. And if you look at China in particular, they've gone headlong into gold since the banking crisis of 2008, 2009. They've been steadily selling down their U.S. dollar denominated debt, selling U.S. treasuries, and effectively buying gold. And they've been followed by India and Russia and many, many other countries. Fundamentally, something changed again when Russia invaded Ukraine, and everybody watched the Russians effectively be shut out of the SWIFT system, isolated, and all their assets effectively seized. And now, of course, they're talking about distributing as much about 140 billion of those assets directly to Ukraine to effectively help rebuild and to fight their war against Russia, so using Russia's own confiscated resources against itself. Everybody looking upon this realizes that a world dominated by the U.S. and the U.S. dollar, they're going to try to dictate things, and I don't think China wants to be dictated to. And many, many other countries feel the same. And so as a consequence, I don't think we're going back. And, what we haven't seen up till now, and I mean very, very recently, we haven't seen a great deal of retail investor buying, not in gold as a commodity, as the physical metal, and not in gold equities. It's central banks have driven the gold price, not gold equities. So the performance of the gold price itself ran way, way, way ahead of of all the gold miners. And you're only starting to see that catch up now as a broader spectrum of institutions have started buying gold equities. Because now the cash flows being generated by these companies are just so compelling. It's attracting the deep value funds. Those have been the first of the broader spectrum to come in and follow the resource funds that have been focused on the sector all along. But what's coming now, and we can just see it, we can track it on the World Gold Council, the ETF holdings have started to really increase. And I think this is the sign of, finally the sign of the individual retail buyer trying to get gold exposure into his investment portfolio. And I think you're going to see a bigger uptake in gold equities, and it's just going to be driven by people looking for deeper value. Why you haven't seen sort of a headlong rush, particularly of, say, U.S. retail buyers, which are by and large, the biggest of the investor block from a retail perspective, it's because the S&P has continued to do so well. The top 10 stocks, all those high-tech stocks in the S&P are still running very, very strong. So people are saying, well, why should I sell my NVIDIA stock and buy gold? They're just not thinking like that yet. But I think it's coming.
It's an interesting reflection you made on the retail market, particularly here in Europe and in Sweden. As you may have noticed when you arrived in Stockholm here, you don't need cash. You use your credit card or even your mobile phone, but you don't really have the value there. And as you mentioned here, John, with people, well, if not leaving, so nations looking at other securities than the US dollar, then obviously prospects for gold, this underlines the interest in gold, I would say. I would argue that the European retailer isn't that long in precious metal physically as maybe there are in other countries. So Eric, what would your reflection be from the investment side here? A lot of opportunities perhaps. But
well, I think this, what John said here is, very, very important for the market. And the de-dollarization is a big theme.
Okay.
And the big currency is gold. That's for sure. It will drive. And we need the Western investors when they come in. And actually also the rotation, the big rotation from bond market, equity market into commodities will also take prices much higher. And of course, especially the miners, where the margin expansion is explosive. And actually for the miners, I think you have a double buying because people buy the miners now, it's good, but they also buy the commodity, it takes the price higher, and that's good for the miners again. So it's like a double, doesn't matter what they buy, it's good for the miners. And coming back to the ratio, I would argue, you said 2030, but we are like 1.5 year in the bull market for precious metals. And when the bull market ends, probably not 2030, but when it ends, we should be down to 30-1 in the ratio. And I would go the other way, Peter, to say this time it will become lower, like Keith said.
Okay.
They will come to 10, 20, or even single digit. But even if we go to 30-1, we see very high silver price. So I think it's a bit different. But 30-1 is the normal place where the bull market, when it tops. So with a 10,000 gold, you will have a 300 silver. And some say 15,000 gold. So you just have to do the maths.
Okay. And it's quite handy then to have a mine and a mint production. I would take it there.
Well, it's a good time to be a miner. John and I have been in this business for about the same amount of time, and it's a very, very tough business. It's very cyclical, and to be a miner for as long as we have, it takes a lot of thick skin, and you have to be quite agile because you have to make decisions often based on how the metal prices fluctuate over time. Laying off 1,000 workers over a period of a couple of months, and then a couple of years later rehiring 1,000 workers. It's a lot of strain on the business, and sometimes mines run into geological issues where you get challenges and you got to deal with them. For us at this time, in our careers, at $4,000 gold and almost $50 silver, it's a great time to be a miner, and it's a great time to be a mining investor. Because I think this market is just starting. I think we're going to see another 10-year bull market here in front of us. And as Eric was saying, we're probably 1.5 years into a 10-year bull run.
Okay, cool. Thank you. And we have one question, I know, from the floor. So please speak in the mic. And we have one question over there. And we'll start there.
Not everything in the world is rational. I don't want to be the devil's advocate, but why is there such a thing as a silver-gold ratio? Silver happens to be a precious metal, but it's used for quite different things. Is this not just a construction that people like to do, and they can do from historical prices? Why not a gold-copper, gold-lead ratio, gold whatever ratio?
There's actually some analysts that measure the oil to gold, copper to gold. You know, I've seen charts like that before, but it's a good point. It's they're
Dollar
totally
to
different
gold.
businesses.
Yeah, the Big Mac ratio used by the economists, for example. You know, it's very true. You know, are we observing something in hindsight and trying to make some sense out of it? And I think there is something to that, actually. You can observe any two things and just compare how they trade over time. But you know, you can garner some sense of value. Although I would agree with you, it would not be my sort of fundamental approach to deciding on making an investment in silver. Especially if I was buying a silver equity, what do I look for? I would look for guys who know how to mine it properly and make money. I would invest in them.
So we will have one question here, and then we have the last question over there. So please go ahead.
Right. Thank you for a very enlightening discussion. I think we all see the the potential here. What about the risks? And I wanted to ask you if you could comment on some historical examples here. It was illegal to hold gold in the US in the 30s when the macroeconomy destabilized. And in recent years, there's been a lot of paper trading and manipulation of prices to go down. How do you see these factors evolving and potentially adding a third factor, nationalization of mines as a risk for investing in miners and equities?
Should I jump in? You know, political risk is something that's very difficult to measure. You know, in Mexico, we just came through a very difficult administration. Fortunately, been replaced by a new administration, which is quite business friendly. So that's very nice to see. So it's you know, these unmeasurable risks. You know, I can't really spend too much time worrying about them. Risks that we do look forward to is really geology. You know, because it is Mother Nature, and Mother Nature surprises you sometimes on a good front, and sometimes not so much of a good front.
So control the controllable in this case.
Try, exactly. Yes.
And we have one question over there.
Thank you very much. Yes, it's on. I listened carefully to your panel discussion, and I understood that it's essentially about efficiency in your mining process when you discuss silver versus gold. My question is, to what extent are you open in innovation in the exploration technology phase? We've seen many panel pitches today where the business plan is underbuilt by massive conventional drilling programs. And I'm asking you, are you mature and open to consider new evolving digital technology that can replace or complement these solutions?
So let's start with a simple yes or no, and then we go there.
I wouldn't even know how to answer that question. You know, from a technological perspective, you know, for milling technology, recovery technologies, we're very active and very proactive. But you know, when it comes to your particular question, I can't answer it.
And John?
Well, we've been one of the companies that's more or less led the way over the last 10 years in terms of exploration innovation. One of the key things that we did when we went into the Island Gold District, where growth in incremental reserve development had been very, very slow, we went in with some new techniques, particularly employing horizontal drilling, which in this case proved to be highly successful. And you could see after we took over, the pace of discovery just soared. So there are new techniques that are being developed. There are new applications of AI in particular, as it's applied to in geophysics in particular. And we've used that quite successfully in both Ontario and northern Manitoba. And it has been a big factor in the increase in the pace of discovery for our operations.
Benoit, the final yes or no?
Absolutely, yes. The average age, we have a team of 250 people in exploration. The average age is probably 32. We use AI, we use satellite, we use everything that we can come up with. And if it's a new concept, we give it a try. And it's been very, very successful. We're using technology from Germany in geophysics, which is absolutely phenomenal. And the best example is Robert Friedland with his iPulse and his technology for geophysics. I mean, he's found major deposit with that. And it's working. It's really working. We're using AI as much as possible, and we're using it in interpretation of the data, because silver deposits are hard to find. They're complicated. And absolutely. Everything that's available, we will try, because it's, and I'll conclude with that. In 1998, somebody came to me. We had all of Burkina Faso. We had like 18 permits. They had never found a mine. Somebody came into the booth at PDAC and say, you know what? Why don't we use geophysics? All our geos left. So this guy is like Professor Tournesol from Tintin, And I said, why not? I mean, I'm an accountant. I'm not a... I said, how much would that cost? And the guy gave us a price. I said, sure, we have 18 permits. We use geophysics. We found the Houndé Belt, which today has like 15 mines. With geophysics, everybody said no, except the accountant said yes. And it worked extremely well. And so, yeah, absolutely, we will try everything if we can see some substance. Absolutely, yes.
So with that, thank you very much for a very interesting discussion. We give them one more applause. And it's high time to...